Ever wonder why the rich seem to get richer while paying less in taxes? It's not some dark secret or illegal scheme, it's just smart and completely legal financial planning. Today I am going to pull back the curtain and show you the exact strategies wealthy Americans use to lower their tax bill, and more importantly, how you can start applying them to your own finances no matter your income level. So, what's the big secret? It starts with understanding how the wealthy make their money. Most of the ultra-rich don't earn their income from a 9-to-5 salary. Instead, their wealth comes from investment stocks, real estate, businesses. And that's a crucial distinction because investment income is taxed differently and often at a much lower rate than the wages you get from your job. This is where capital gains taxes come into play. For 2025, the highest tax rate on long-term capital gains is just 20% for top earners. Compare that to the top federal income tax bracket, which sits at a hefty 37%. That's a massive difference, and it's all perfectly legal. The system is designed to reward investors, and once you understand that, you can start using it to your advantage too. Let's dive deeper into capital gains, because this is probably the single most powerful tool the wealthy use. A capital gain happens when you sell an asset like a stock or a piece of property for more than you paid for it. The magic happens when you hold onto that asset for more than 1 year before selling. Once you cross that 1-year mark, any profit you make is considered a long-term capital gain and qualifies for that lower tax rate I mentioned. This is why the rich are so patient with their investments. They let their money work for them over years, even decades. Imagine you invest $100,000 in a stock. If you let it grow for 10 years and then sell, your profits are taxed at that favorable long-term rate. If you had sold it in just 11 months, that same profit would be taxed as ordinary income, potentially costing you tens of thousands of dollars more in taxes. Historically, the S&P 500 has returned about 10% annually on average. By simply holding on and letting your investments compound, you're not just growing your wealth, you're also setting yourself up for a much smaller tax bill down the road. It's a classic win-win. Next up are tax-advantaged retirement accounts. You've probably heard of them: 401ks, IRAs, and Roth IRAs. Wealthy individuals max these out every single year, and for good reason. These accounts are like superpowers for your money. When you contribute to a traditional 401k or IRA, you often do it with pre-tax dollars. This means you lower your taxable income for the current year, saving you money right now. Your investments inside that account then grow tax-deferred, meaning you don't pay any taxes on the gains year after year. You only pay taxes when you withdraw the money in retirement. With a Roth IRA or Roth 401k, you contribute after-tax dollars, but then the money grows completely tax-free. That means all qualified withdrawals in retirement are yours to keep, with the government not taking a single cent. The rich understand that letting your money compound without the drag of annual taxes is a massive accelerator for wealth building. Here's another savvy move the pros use: tax loss harvesting. This might sound complicated, but the concept is simple. The stock market goes up and down, and even in a good year, some investments will lose value. Tax loss harvesting is the strategy of selling those losing investments to realize a loss. Why would you want to do that? Because you can use that loss to cancel out capital gains from your winning investments. If you have more losses than gains, you can even use up to $3.00 of those losses to reduce your ordinary income, which is taxed at a higher rate. This turns a market downturn into a tax-saving opportunity. The rich don't just sit and watch their portfolios bleed. They strategically sell losers to offset gains elsewhere, reducing their overall tax liability while rebalancing their portfolio. It's about finding the silver lining in every market swing. Let's talk about a more advanced strategy: strategic income shifting, now. This gets into the territory of high-level financial planning, but it's important to understand. High net worth individuals often structure their finances to shift income to people or places with lower tax rates. For example, they might set up family trusts to pass on assets to children or grandchildren who are in a much lower tax bracket. This is done with careful planning and is completely legal. For small business owners, there are similar strategies. Instead of operating as a sole proprietor, where all your income is subject to self-employment taxes, you could form an LLC or an S corporation. This allows you to pay yourself a reasonable salary and take the rest of the profits as distributions, which are not subject to self-employment tax. This one move can save thousands of dollars a year in taxes, freeing up more cash to reinvest back into the business or your personal portfolio. So how does this all fit together? It's not about using just one of these tricks, it's about building a comprehensive financial system. The wealthy combine all these elements. They prioritize long-term investing to get favorable capital gains rates. They max out their tax-advantaged retirement accounts to let their money grow shielded from taxes. They use tax loss harvesting to turn market dips into tax deductions. And they structure their businesses and estates to legally minimize their tax burden. The key takeaway here is that they are proactive, not reactive. They don't wait until April to think about taxes, they're planning for them all year long. Even if you're just starting, applying one or two of these principles can make a real difference. Simply holding an investment for 12 months in a day instead of 11 months can change how it is taxed. Opening and contributing to an IRA is a huge step. It all adds up. The great news is you don't need a seven-figure income to start using these strategies. You can begin right now. First, if you invest, focus on the long term, buy quality stocks or ETFs and plan to hold them for more than a year. Second, take advantage of retirement accounts. If your employer offers a 401k with a match, contribute at least enough to get the full match. It's free money. If you can, aim to max out your contributions to an IRA or 401k each year. Third, as your portfolio grows, learn about tax loss harvesting. When you rebalance your portfolio, consider selling some losers to offset gains. And finally, don't be afraid to seek professional help. A good certified public accountant, or CPA, can provide tax strategies tailored specifically to your financial situation and help you navigate the rules legally and effectively. Their fee is often an investment that pays for itself many times over. Remember, paying less in taxes isn't about cheating the system, it's about understanding the rules and using them to your benefit. These strategies that the rich use are available to anyone who is willing to learn and apply them. Start with one small step today, and you'll be on your way to keeping more of your hard-earned money and building long-term wealth. If you found this helpful and want more tips on how to grow your wealth and save on taxes legally, make sure to hit that subscribe button. And I'd love to know. Drop a comment below and tell me which strategy you're going to try first. Thanks for watching.